A&M's Execcom practice. I'm joined today by Alex Gardner, a Senior Director in the practice. Today we are going to be talking about, this webinar is in support of our FTSE 350 Executive Director Remuneration Report, which we launched this morning. The report is a comprehensive analysis of all aspects of Executive Director remuneration. It is based on the very latest disclosure from this AGM season, including up to and including the March year ends, which is a fantastic job for our team to be able to pull all that together, bearing in mind those were published, the latest were published sort of late July, early August. So the team has done a fantastic job in doing that. We cover the FTSE 350, so we'll split the analysis into the 100 and the 250 and some subsets of that, FTSE 30, top and bottom halves of the FTSE 250. We haven't extended this one to the small cap. We normally do in our reports, but that's the trade-off we make with trying to get this report out as early as possible. But that's something we'll probably look at in the future, because we do like to we don't want to leave the small cap behind. But today we are looking at the FTSE 350. So the report's available if you follow the QR code there. If you are on our distribution list, you will have received it this morning. And if you'd like hard copies, get in touch, because we have some of those too. We're going to talk today about sort of all the aspects of Executive Director remuneration, salaries, salary trends, incentive, opportunities and outcomes, new policies, and some of the interesting themes we're seeing in it. Of course, this AGM season has taken place at quite an interesting time for the UK market, and some of the themes that have been part of this sort of, so it's called big tent discussion on executive remuneration. Some of the themes we're seeing do seem to be reflecting some of the considerations, some of the thoughts that have been part of that debate. The webinar is being recorded, and we will distribute recording. We will distribute the slides to the participants following the end of this. There are opportunities to ask questions throughout. So I believe there's a Q&A function within the webinar that you can use to submit anonymous questions to myself and to Alex. If you want to, there's also, I think, the chat function, which would be public, and you can, if you want to comment or ask questions that way, you can. So please do. And we'll start with salary. So clearly, the employee context for salary has been increasingly important in recent years. And if you think back, for many years in the UK, it was very common that the all-employee increase would generally be 2 to 3%, fairly straightforward. And then last year, in the inflationary environment, the cost of living pressures that we saw last year, the increases were much higher. They spiked much higher. And so what are we seeing this year? Well, 67%, so two-thirds of the FTSE 350 had a lower all-employee increase this year than they did last year. And the statistics are there in the chart, so that's the median and quartile range. The median increase was down this year from 6% to about 4.5%, which is not unexpected given the change in the inflationary environment. But it is still above that 2 to 3% that we saw consistently for so many years prior to that. The other things we've seen on the broader employee piece is fewer one-off payments. If you remember, they were very common last year, again, to reflect cost of living. So way down this year. And the use of tiered salary increases. So your most junior, lower paid colleagues having the highest increases. That is still seen, but it only looked like it's around about 10% based on the disclosure in the last year or so. So that's lower than it was last year. So moving on to the executive directors, again, historically, when all employee increases were in that 2 to 3% range, it was very, very common that your executive directors would be aligned with that. That was a common practice. Then last year, when the all employee rate spiked, what we saw is it became very common for the executive directors to be increased by a smaller amount. So a discounted approach was taken for the executive directors. So again, what are we seeing this year? So it still is the case that this discounting approach has been very common. So we've got the stats here for the 100 and the 250. If you look in the 100, we are 54%, so just above half of the FTSE 100 have discounted the executive director increase compared to the all-employee increase. And similar, even higher in the FTSE 250. But what we also saw is an increase in the number of companies setting the executive director increase in line with the all-employee average. So again, in the FTSE 100, that was up to 33% from just 11% last year, and similar in the FTSE 250. So discounting is what we're continuing to see, but it's interesting if you get behind the data. There is a trend. There's a bit more to it than that. So what we're finding is that the likelihood of a company discounting the executive director increase is higher if they have a higher all-employee increase. So let me explain this chart, because it's sort of funny colors that our designers chose for this one. But let me try and explain what's happening. So this is the FTSE 350, and each bar here is the all-employee increase in that particular company. And each of the associated sort of white dots, white markers, is the executive director increase in that company. So I think what you can see here is if you look at the lower end of increases, so if you look at the sort of 3% all-employee increase on the left-hand side, 3%, 4%, 5%, you get a lot of companies within there that are setting the executive director increase in line with that all-employee increase. So the sort of white dots that sit along the top of the bars. But as you move towards higher increases, so once you get up above sort of, the average employee increases of sort of 6%, 7%, quite high increases, you tend not to see the executive director being aligned, and you tend to see more discounting there. I think the other thing probably worth pointing out here is, there are still really only a handful of examples of companies putting the executive director increase above the average all-employee increase. Again, most cases that's been driven by benchmarking, by concerns around talent market competitiveness, and often around strong performance in the business. Those are the most typical sort of rationale that we heard to support those increases. And generally speaking, ISS and shareholders have been fairly benign and fairly supportive of those increases. So finally, have you put that all together, sort of net, as the phrase goes? So overall, executive director increases are broadly in line with where they were last year. So around, for both FTSE 100, FTSE 250, CEO and CFO, median increases are still around 4%, which kind of makes sense if you think of the dynamics, that the all-employee rates are down, but fewer companies are discounting. More companies are in line with those rates. So overall, that's keeping the market at sort of 4%. And with that, I will hand over to Alex to carry on.
Okay, so pension and benefits. So two relatively small packages, parts of the executive package, and so pension there on the left, having already being a small package, the story is that it's getting even smaller, in that over the last few years, as shareholders have been pushing for pensions to be aligned with the workforce level, we've seen pension rates fall dramatically in the FTSE 100 and the FTSE 250. So now the median sits around 8 to 10% and pretty similar there. So the FTSE 100 sits slightly higher in terms of pension contribution, and the FTSE 250 slightly lower. Moving on to benefits, so another small element of an executive package, we've got the FTSE 100 typical level is about 30K in benefits. And that includes things, like we've got car allowance, life insurance, health insurance. And some of the bigger numbers there would be things like travel allowances, or, if you've got expatriate arrangements as well. And going down into the FTSE 250, benefit levels tend to be a little lower at 20K, but pretty similar throughout the FTSE 250 at the top and bottom half. But typically there, the main thing is pension and benefits, not much change year on year. Pension, we're just seeing what we've seen for the last 3 to 4 years, constant reduction, but seems to have leveled out now because most companies are aligned with the workforce. In fact, looking across the FTSE 350, I think we only found about 1% of companies which had not aligned the pension with the workforce. And those were very particular circumstances. So, for example, maybe you have an executive director based abroad who is aligned with the UK rate, but isn't actually aligned with the local rate. And so then they're not necessarily judged to be entirely aligned with their workforce. Or in other cases, if companies are not aligned, it could be they have a plan in place to align, but they just haven't got there yet, which is quite unusual because many companies, put in plans to get to get their pensions aligned pretty rapidly, but some apparently, one or two, still haven't got there yet, but should be there soon. Anyway, pension and benefits. Moving on to the next one, we have incentive outcomes. So what these charts show for annual bonus, we're showing the annual bonus outcome as a percentage of maximum over time. So on the left, the FTSE 100, we've got the annual bonus outcomes from 2019 all the way through to 2023, showing the lower quartile, median, and upper quartile for each year. And then we've got the same for the FTSE 250 on the right. Now, these tell a story I think we're all quite familiar with, which is 2019, everything's pretty, pretty normal. 2020, then crazy things happen in the world and the bonus levels drop quite dramatically. 2021, companies then think, oh, how much are we going to rebound? Let's try and set targets, probably set the targets a little low. So then bonus outcomes shoot way up there to around 90% or, as median for the FTSE 100 and something similar, but not quite as dramatic in the FTSE 250. And then everything starts getting a little bit back in order in 2022. And in 2023, our latest set of data, we see that actually things seem to have stabilized a bit. So not much has moved 2020 to 2023 annual bonus outcomes. You can see a little bit of a shift in the median. Maybe you could say in the FTSE 100 bonuses up a little, FTSE 250 bonuses down a little. But when you look at the spread of data, I don't think it's enough to really say there's any big trend there. But what is interesting about annual bonus is the exercise of discretion. That's a common topic. And here we have set out, we've looked a little bit in more detail at discretion because it's often, a point of interest. Now, before I go into what have we looked at, well, what have we not looked at rather? We haven't looked at exercises of discretion, which are, for example, to adjust a target range because there was a capital injection, which you then had to change your cash flow targets or something like that, or an exercise of discretion because there was an acquisition. And so you had to fiddle your range a little bit just to make sure that the targets were as tough as you originally intended. So we haven't looked at that. And we also haven't included here companies where it's not quite clear what the impact of the discretionary adjustment was. And there are quite a few like that. They'll just say we exercised discretion and this was the outcome. So these are just the companies where it was clear what the adjustment was, and also ones which made a change to the actual bonus outcome. So they calculated everything and then they said, okay, we now want to we take an overall view for other factors and we want to make an adjustment. And based on that, we found about 13% made some kind of discretionary adjustment to the bonus. And as probably everyone on the call knows, discretionary adjustments tend to be always down and never up. And that is illustrated here in this chart. But I'll come back to that in a second. Anyway, so having looked at all these discretionary adjustments, we then put them in 3 categories with the different colors there and ordered them, broadly by the impact of that adjustment. So right at the top, we have about 6 companies in the dark yellow who basically reduced the bonus entirely to 0 because the financial targets were not met. So these are cases where, you set a profit target, you didn't meet the profit target, you still maybe met some strategic parts, in your bonus, but you thought, well, we missed the profit element so much, we'll wipe those out. All right. So those are pretty easy to explain. Then to go to another one, which is relatively easy to explain as well, at the bottom there, and I think that's light gray, is the safety ones. Now, these are, as obviously from the key, these are where there have been safety incidents at the company, and these are seen at oil and gas companies, miners, manufacturers, and often to do with fatalities as well. And an adjustment is made at the end of the year, and typical adjustments here, as you can see, have ranged from somewhere around 5% or 2 to 3% to maybe minus 15%. So that's a pretty separate category and specific to a certain industry. And then in the middle there, in the light yellow, we've got a much wider range of adjustments to do with align pay with performance. And here the reasons are quite wide. We've seen quite a few things in that. For example, ESG targets. We've seen the company might have set ESG targets at the start of the year for emissions, then other things have happened during the year, they've outperformed, and so they've actually cut back just on that element. And other ones all tend to be sort of adjust. They look at performance in the round and then say, well, this formulaic outcome hasn't quite reflected how we think performance has been. And the minus 100% adjustments there are typically also backed up by significant falls in share price over the year, probably something to do with the future outlook of the company. Now, just before we move on to the next slide, I say, most of these adjustments, are negative. Well, there are some instances of positive discretion as well, but these are quite rare. And the only few we found actually related to instances of conflict in the world. So one positive adjustment was to do with exceptional performance by the executive team in helping manage a situation in Sudan. And the other one was to do with managing the impact of the Israel-Gaza conflict on their markets. So if you want to exercise positive discretion, the threshold's pretty high. But there you are. So over to the next one. So here we have LTIP outcomes on the left, and on the right, the impact on the CEO single figure. So starting with the LTIP outcomes. Now, obviously in LTIPs, you've got your PSPs, you've got your performance share plans, your restricted share plans, and single incentive. There's a whole wide range, which James will go into in a second. Here, we're just looking at the performance share plan. So typically 3-year performance period and measure performance at the end, and then you get a vesting outcome. And here, the story is similar, but slightly different to the annual bonus, where in 2019, everything's kind of normal. 2020 get hit by the pandemic. 2021 rebound a little, and that rebound has just continued up to 2023 now, where we've kind of got back to 2019 levels. Again, the median can be a little deceiving there. The upper quartile has been actually pretty consistent almost throughout, but you can also see the lower quartile raising as well, so showing that we're getting back to some kind of normalcy on PSP vesting outcomes. And to sum that all up, what's happened to the CEO single figure? Well, from 2022 being just under 4 million total pay for CEOs, it's gone up to about 4.1 million for CEOs in the FTSE 100. This is just for the FTSE 100, what we're looking here. So the overall story being annual bonus, pretty much similar year on year. LTIP slightly higher, but actually quite a bit higher median year on year, and that's driving the single figure up slightly. And James, over to you, I think, for the.
Where we've got in the presentation here, FTSE 100 data, the FTSE 250 is in the report as well, so I encourage you to look at that. What we're going to do now is move on to some of the forward-looking stuff we've seen. So in particular new policies and some of the key themes. So first of all, on incentive opportunities. So we're seeing about a fifth of the market overall will increase incentive opportunities for 2024 for the current financial year. And within the subset that we're looking at the policy, that we're approving a new policy, it's 42%. So nearly half of new policies have built in an increase to incentive opportunities. The median data is shown there on the slide. But again, I'd encourage you to look in the report where we've got the detailed breakdown by different parts of those two indices. Broadly similar proportion across both 100 and 250. This isn't just happening in the 100 or just the 250. It's pretty similar. I think interesting that most of these increases are via the LTIP. So 60% of the increases come via the LTIP. But also interesting to see that a quarter of these increases were companies pushing up both the bonus and the LTIP, which I think conventionally can be quite challenging to try to increase both elements of the package, the incentive package at the same time. And generally, the most increases have been at the sort of 25%, 50%, maybe 100% of salary, sort of relatively sort of acceptable from a shareholder perspective. I think the ones that pushed it a bit higher than that generally did find that ISS was still found that challenging. A couple of high profiles that found it quite challenging to push those through. But generally, most of these increases were supported by relatively minor and were supported by shareholders. I think the rationale, again, similar to salary, the rationale that we saw for a lot of these increases was around re-benchmarking in global talent markets, the competitive talent markets that's challenging to compete in, and around the performance of the business and looking to ensure continued performance and strategic delivery. Those are the main reasons that we saw with these increases. Moving on to the structure of incentives, we'll start with bonus deferral. So bonus deferral remains very, very common across the market, typically a third to a half of bonus, typically deferred for normally 3 years. So all the standard stuff that you'll be aware of. I think the interesting thing here is that the theme we've seen here plays into the big tent discussion and the point that a number of the features which have become standard practice in the UK market to drive shareholder engagement, so bonus deferral being one, LTIP holding periods and shareholding guidelines and post-cessation guidelines, have they become too complex, too onerous, and because the IA said potentially disproportionate to the objective they're seeking to deliver, and challenging the UK in how it competes in global markets, and how it creates a divergence with the executive directors and maybe executive committee, where often some of these provisions don't apply. So what we've seen, the big trend here that we've seen is in 19%, so just 1 in 5 new policies have in some way relaxed their approach to bonus deferral. And the most common way is to reduce the amount which must be deferred once you've met your shareholding guideline. So there are a handful that just reduced the amount that must be deferred, but most of the reductions, which as you can see in the chart here, so most of this left-hand side of this chart, were companies saying, once you've met your shareholding guideline and you have a bonus payout, you test that and you'd say, if you've met it, your deferral level can be lower or reduced to 0 and not applicable at all, which kind of makes sense from our perspective, and in the sense that the purpose of the bonus deferral is to create alignment between your executive directors and your shareholders. If there is already a material shareholding that creates that alignment, why does one need further bonus deferral? So that's a really interesting theme, and now it's in place in some sort of conditional approach to bonus deferral is now up to 11% of the FTSE 350. I think certainly clients we're talking to, I would encourage you, if you have a remuneration policy review, to take a look at this as to whether this is something that would work for your business. And we'll move on to stay with structure, but we're looking here at the structure of the long-term incentive. So first of all, chart on the left-hand side, PSPs do remain very dominant practice in the 100 and the 250. So still about 80% or so of companies are using a PSP. That's the sort of market snapshot. But if we look at what's happened just in the new policies, so again, it looks odd because it's exactly the same number, but 19% of new policies changed their LTIP structure in the year. And the chart on the right-hand side shows company by company what they had on the left-hand side and what they moved to on the right-hand side. So it just gives you a feel for some of the movement that's happening. And there's two themes that I think we would really draw out here. One is at the top there, we've got 6 new hybrid plans in the FTSE 350. So by hybrid, we mean a combination. In fact, here in each case, it's a combination of a conventional LTIP PSU with restricted shares. The idea being that you can somehow combine the benefits of the retention and the shareholder alignment element from restricted shares with a performance element in the LTIP and in the PSU. Rather than what we've seen in the UK since restricted shares sort of became an option, that typically you've had to choose. You either have to have a LTIP or you have to have a restricted shares. It's been difficult to get both. So that's a very interesting development. Now, the ISS position on this has been quite interesting because of 5 of those 6 hybrids they opposed. But our analysis of that is that it's largely been because those companies have simultaneously been fairly materially increasing the quantum available under the combined LTI, rather than just switching on a sort of quantum neutral basis into a different structure. We think that the ISS have been pushing back a bit on the quantum element rather than the structural change. But really interesting that the market does seem to be potentially more receptive of hybrids. Again, it's a big tent theme, because if you're competing particularly in a North American talent market, or influenced by North American talent markets, hybrids are 95% plus of the market over there. So very, very common. And I think we're increasingly seeing UK companies adopt hybrids below the board, and then you get this sort of disconnect if you can't do that for your executive directors. So, very interesting that we're seeing this theme. We think that it's going to continue. We think companies are going to be interested in hybrids and exploring whether hybrids work for them, work for their business. I think the second theme, though, which is again really interesting, the idea that the UK is sort of moving towards real innovation and everyone will have a different type of plan and there'll be huge flexibility. Possibly there is more flexibility, but equally we've got a few examples here, if you look in the middle of that right-hand chart, of companies moving away from something slightly unusual, either restricted shares, or we had a couple moving from a value creation plan, a matching plan, moving away from something unusual into a PSP, a conventional PSP, which I think shows you that the PSP as a concept is not dead. It's not going anywhere. It's still 80% of the market. It still has real benefits to lots of companies. It's a simple framework that they can use and tailor it and make sure it works for their business by the choice of the performance measures and how the targets are calibrated. But the basic framework still remains, it still works for lots of companies. So I think yes, there is an option here to move towards hybrids, but one doesn't need to necessarily if a PSP will continue to work. So those are the key themes on the LTI structure. Alex?
Okay, performance measures. So in the report, we also have for the FTSE 100 and 250, the performance measures for the annual bonus and LTIP. Here we've shown the FTSE 100, and so many things are kind of similar as prior years. And for example, annual bonus profits, that's still the main measure. If you go to the LTIP, the key measures tend to be a relative TSR and some kind of profit measure as well. However, ESG has been the big story over the last few years. And we see a continued increase in that. We think there's around, in the FTSE 100, for example, maybe around 80% of companies have ESG in their annual bonus. But we think that's probably starting to top out a bit. And so instead of just showing in the report, how many companies have ESG, we've tried to get under the skin a little bit and look at, what kind of targets are companies setting. So, for example, we've broken it out there in the annual bonus into people targets, emissions, and we've also got other sustainability. ESG is also a little bit hard to define. So, some companies might also have a customer element, which some will put in ESG, others won't. So sort of defining what counts as ESG is kind of difficult because different companies have different definitions. And so we've tried to break this out a little bit more so you can actually see what kinds of targets are being set. The things that we took away from just looking at the FTSE 100, for example, is that people targets are more prevalent in annual bonuses. And if you go into the LTIP, you see a lot more of emissions targets. And those are sort of the two dominant kind of ESG targets in each incentive. But that's not to say that in annual bonus, you don't see quite a wide range. You've got people targets, emissions, customer. Some even put safety under ESG, even though you wouldn't necessarily say that's an ESG measure all the time. Now that ESG has become, well, not standard, but quite high prevalence, especially in annual bonus. And in LTIP, it's continued to increase in prevalence. We expect there's going to be a bigger focus on target setting as we move forward. I mean, we already saw in the discretion examples, we saw companies adjusting targets because they didn't feel like they had set their emissions targets quite right. And we think that that focus of companies and also from investors is just going to increase. So probably something we'll also start looking at in future reports. So moving on to the shareholding requirements. So shareholding requirements. Companies typically have in-employment and post-employment shareholding requirements. The big table on the right there is the in-employment ones, and it's probably the easiest one to deal with, in that we haven't seen much movement in that. That's the number, the amount of shares you need to hold whilst you're employed, and you need to build up to that holding during employment, typically over a 5-year period, sometimes through the sort of almost compulsory retention of your share awards. And the median level of shareholding requirement in employment in the FTSE 100 is 325%, and in the FTSE 250 lower at 200%. These are pretty similar to the median level of LTIP award as well. So that's usually a good benchmark as well, and idea to how these are set. So in the FTSE 100, that the median LTIP award is about 300%. So the shareholding requirement is slightly higher at 325. And in the FTSE 250, the median PSP award for a CEO is 200%. And that's the same as the shareholding requirement. So there is some alignment there. Now, moving on to the post-cessation requirements, this is a relatively new element of executive remuneration, which is one of those things that adds to the just the complexity of the arrangements. And now the requirement here that let's say is industry best practice, or at least what the IA would like everyone to do, is to hold the in-employment requirement for another 2 years post-employment. So for example, if you had the median FTSE 250 company, that would mean holding your 200% salary for another 2 years after employment. So 70% of companies across the FTSE 350 are now compliant with that investment association guideline. That has increased, all right? And we've seen that increase over the last few years. And with each company's policy renewal, we see more and more companies adopting this IA approach, and especially if they're looking to increase some element of their package, right? Now, companies which don't follow the IA, they usually have some other kind of approach, such as they have a tapered approach. And that could be something like you hold your unemployment requirement for 1 year and then it halves in the second year. Or it could be you hold your full unemployment requirement just for 1 year after employment, and then you can sell all you want. But I think the main thing there is it's currently at 70% of companies following the IA, and we think that's going to increase as we see more policies renew over the next 3 years. So to you, James. I think that's.
Thank you, Alex. Okay, so finally we're on the sort of AGM season voting outcomes, and overall it's been a pretty benign season from a company perspective. If we look first at the views of ISS, the main proxy voting agency, the most influential proxy voting agency, the charts here show the percentage of the market receiving an ISS against recommendation, both this year and a few previous years. For the policy, those are the left-hand charts, and the DRR, those are the right-hand charts, and for the 100 and the 250. And if we start on the DRRs, as you can see, it's a really very low level of ISS opposition, historically low level of ISS position, particularly in the FTSE 100. So only 2% of FTSE 100 DRRs received an against recommendation. Slightly higher in the 250, so 7% in the 250. But again, if you look at the trend, that's a historic low. Where there was opposition to DRRs, it tended to be the similar stories that we've seen in previous years. So concern around lack of disclosure on performance targets, or a lack of sufficient performance story to support the outcomes. Some concern, not a huge amount as you can see in the data, but some concern around quantum increases or salary increases. Generally, salary was fairly well supported, as I said earlier. And there's a handful where there's this concept that there hasn't been sufficient response to a previous investor concern or opposition to a vote, and that's underpinned some of this opposition too. But generally speaking, very, very low on the DRRs. On the policies, so the left-hand chart there, again on the FTSE 100. A historic low in terms of ISS opposition, but still at least closer to historic norms. And on the FTSE 250, slightly higher than normal, but a large chunk of that, around half of that 15%, around half of that 15% is opposition to the hybrids, which we discussed earlier. So I think if you take out the hybrid piece, they would be, again, at a historic low. So that's ISS, and then of course ISS tends to very strongly influence the voting outcomes. So this chart, just the FTSE 100, you can see there's a pretty strong correlation here between what we showed previously on ISS and what the outcomes are. Again, on the DRR, very, very low number. This is the percentage of the market receiving a low vote, as in below 80%. And very, very low on the DRR, a bit higher on the policy. I think the sort of $1,000,000 question here is, is this going to continue? Is this sustainable? And I think I wish we knew. I think it's probably too early to say. I mean, on the one hand, I think there are some aspects of the analysis which suggest it is an anomaly. So, ISS opposition was pretty low in the 100, but it was still reasonable in the 250. And on the policies, again, in the 250, it was still, it hadn't dropped completely to zero. But at the same time, I think, it's reasonable to assume there is some pressure coming out of the Big Tent discussion on ISS to be just slightly more supportive than they have been in the past. So it's one to keep an eye on as we progress. And I guess the most immediate point to think about will be the release of the Investment Association update on their principles following their review, and then how that feeds into the ISS policy review later in the year, where they've said they want to wait for the IA first and then they'll take a view. So I think, you know, that obviously that's the key piece to from now until the end of the year to stay abreast of. So obviously we'll keep everyone updated with our updates when something happens in that area. So that's what we've got for today. So 10:42. We have 18 minutes. We did pretty well to get through that, Alex, in the 18 minutes. Do we have any questions to have a think about?
Yes, we have. Well, firstly, I'll do them in order. So the first is a technical question, actually, on shareholding requirements. Do unvested deferred bonuses or LTIPs count towards the shareholding requirement, or just vested shares?
So I think they should count, and where there is no further performance required, so a deferred bonus that's based on annual performance, or an LTIP award that's vested and is in a holding period, and you don't yet have the shares, they should count on the basis that they have been earned. It's consistent with the principle in the IA guidance. I think you need to make sure that you only use the net of tax position, because obviously once those shares are transferred or beneficially held, there'll be a tax charge and you only get the net amount. So making sure you're only taking the net amount, but they should count, I think.
Right. And another question from a keen-eyed observer of the voting chart is so in the policy, I'll try and summarize it. In the policy votes, yeah, over there, yeah. So there you go, that chart there. The policy AGM voting. Actually, if you go, is this the ISS ones? There we are. So the ISS against for policy don't seem to then feed into the next year in terms of against on the DRR. Is the idea, and I guess that's the same for the AGM voting outcomes as well, does that mean if you get your policy across the line, you don't really have to worry about investor reaction for the following 3 years?
It's a good question. So I think you do have to worry about it, but it sort of depends. I think we'd all like to think, and I think the way that the market used to work was that if you had your policy approved, you could then, it's approved and you could operate it and everyone would move on. Shareholders would move on and ISS would move on. Maybe not all shareholders, but generally they would move on. I think what we've seen in the last couple of years is that certainly with ISS, if they think that the vote on the policy is at a sufficiently low, maybe it's passed, obviously it's passed, but if it's a sufficiently low level, if there's a sufficiently big opposition, then if you're not seen to have responded to that via consultation or via amendments to the proposal, there is a probability that they will then say in the next DRR there was insufficient response to shareholder opposition. But our analysis of this, it's difficult to know exactly what the threshold is for ISS or for other shareholders, because I don't think that if you just go below 80, that's considered a lot too much opposition and you need to amend your proposal. So if you get 79% on your policy, I think you probably expect you'll be okay on your next DRR. Our analysis suggests once you go below the 70, so maybe high 60s, that's the threshold. ISS haven't published this as far as I'm aware, but that seems to be the threshold where they start to say, okay, that you haven't responded sufficiently on this. So yeah, that's our analysis of the position.
Right. Well, we have another question from. So this is about incentive performance metrics. All right. So the question is, does it make sense that there's still a typical framework that is led by TSR and profit and EPS? The typical TSR EPS thing in LTIPs. Do you see there being more companies looking at more tailored approaches that is more relevant to their longer term strategic goals?
Sure. Do you want me to answer that, Alex?
Yeah, go for it.
Yeah. Yeah, I think so. I mean, I think certainly the FTSE 100 for a number of years is becoming is starting to use a wider range of metrics that often will include TSR or EPS or the standard ones, but will have a broader range of other financial metrics as we can see here, or operational and or ESG based metrics. In the FTSE 250, it's really changed. If you look back 10 years or so, it would have been a lot of companies would have had a very standard TSR and EPS, almost 50-50, and that was the model. And that's really moved on. I mean, we don't have the 250 chart here, but it's not dissimilar to this FTSE 100 one. And I think it's I think as long as you've got a very clear rationale for your measures and you can show how they link to your strategy and your KPIs, how they link through to shareholder value or the sort of stakeholder outcomes, I think shareholders are increasingly supportive of that. I mean, there are some instances we see where companies have metrics in their incentives which don't necessarily line up with their strategy or obviously line up with their strategy and their KPIs, which I personally think is pretty poor practice to be using an incentive that might be based on, include return on capital or something like that because your shareholders have pushed for it, but actually you don't seem to use it in the financial reporting or presumably in the way the business is being run internally because it's not a KPI. And I think that's where there's a bit of a breakdown between the alignment. But back to the question, I think yes, it's more common and it's more accepted, and certainly it's what we as advisors would look to support our clients with. Going through that process of saying how do we best align this with what we're trying to deliver, and not necessarily with just what everyone else is doing.
Another crystal ball question. Do you have any expectation for salary increases in the future? So what would the for the executives? Yeah. What do you think it's going to be next year? And I'll write it down and hold you to account for it.
So yeah, that's a good question. I think where we're going in the UK with inflation is still not uncertain, but it's still not certain where that trend is going to land. But I think we'd expect all employee rates to be lower this year. So if it was, I think the median last year 6% down to then 4.5. I think something starting with a 3, probably in the 3, around the 3%. I think is what it's a bit too early for the December year ends to be looking at that yet, but just sort of anecdotally on initial discussions we're having, it's more likely to be around that range of sort of 3. And then with executive directors, the question is, will that prevalence of discounting continue once the all-employee rate drops to 3? And I think probably not. I think what we'll probably see is kind of what we've seen this year, is that the all-employee rates come down and more companies go back to keeping their executive directors in line with their all-employee increase. So that's what I'd be thinking, that it's probably 3.5, maybe 2.5, 3.5 for this year. I think the other thing with executive directors is, we showed, let me just go back to this chart because it's an interesting one. So sure, when you see the range of executive director increases that are in there, that's very different from, as I said, the previous very conventional 2 to 3% sort of standard increase each year. I think what this means is that if you happen to be at the lower end of this chart, so if you happen to be in a business that's done 3% employee increases, 3% or lower executive director increases for a couple of years, like this year and maybe the previous year when it was everybody was discounting. If you benchmark again, what you might find is the market has moved a bit more than it used to. So it could be the case that we find, get to sort of bit year-end benchmarking and think, our executives are a bit off what we thought they would be, which didn't used to be the case when everyone was just doing 2 or 3%. If you benchmarked one year, following year, or maybe the year after, we used to encourage clients not to sort of over benchmark because the market wasn't hugely moving. Now I think it is, because of this range that exists, it's more likely that you might find yourself in slightly out, or at least go through the process of sense checking where you are against the market, would be our advice.
Very good. Oh, wait, I think that's it for the questions. I don't have anything
Okay,
anything else up. So let's see.
that's great.
Yeah.
Okay, well, we'll give you back 8 minutes of the day. So thank you again for joining. As I say, we will distribute the recording and the slides, and we look forward to seeing you next time. Thank you.